Investing is about growing your money over time. It's a strategic way to ensure that your hard-earned money doesn't just sit idle, but instead works for you, multiplying and compounding over the years. It's a way to beat inflation and make your money work harder for you. Inflation can erode the value of your savings, but investing can help you stay ahead of it by generating returns that outpace inflation. Even small amounts, invested consistently, can make a big difference in the long run. The key is consistency and time. By regularly setting aside even a modest amount, you can harness the power of compounding. Imagine a snowball rolling downhill. It starts small, but as it rolls, it gathers more snow and gets bigger. This is similar to how your investments can grow over time. That's how investing works. Your money earns more money, which then earns even more. This is known as compound interest, where the interest you earn also earns interest, creating a snowball effect. Think of investing as planting a tree. Just like a tree needs time to grow from a small seed into a towering oak, your investments need time to mature and yield significant returns. You wouldn't expect a tree to grow tall overnight. Similarly, you shouldn't expect immediate returns from your investments. Patience is key. The same goes for investing. It takes time, patience, and consistent effort to see significant growth. Regularly nurturing your investments, just like watering a plant, is essential for long-term success. But with time and nurturing, that small seed can grow into a mighty oak. Your investments, given enough time and care, can grow into a substantial financial foundation. Investing is not just for the wealthy. It's a common misconception that you need a lot of money to start investing. In reality, anyone can start with small amounts and gradually build their portfolio. It's for anyone who wants to build a secure financial future. Whether you're a young professional, a family, or nearing retirement, investing can help you achieve your financial goals. Whether you're saving for retirement, ensuring you have enough funds to live comfortably in your golden years, a down payment on a house, or your child's education, investing can provide the financial support you need for these significant life events. Investing can help you reach your goals faster. By setting clear financial goals and investing towards them, you can make your dreams a reality sooner than you might think. Remember, the best time to start investing was yesterday. The earlier you start, the more time your money has to grow. The second best time is today. Don't let another day pass by without taking steps towards your financial future. Don't wait for the perfect moment. There will always be uncertainties, but starting now is better than waiting indefinitely. Start small, learn as you go, and watch your money grow. Educate yourself, seek advice if needed, and take the first step towards a more secure financial future. Before you start investing, it's crucial to define your financial goals. What are you saving for? When do you need the money? Having clear goals will help you determine how much to invest, your investment timeline, and the types of investments that align with your objectives. Are you aiming for short-term goals like buying a car in a few years? Or are you looking at long-term goals like funding your retirement decades from now? Short-term goals might require more conservative, lower-risk investments, while long-term goals can handle more volatility and potentially offer higher returns. Once you've identified your goals, write them down. This makes them real and tangible. Having a visual reminder of what you're working towards can keep you motivated and on track. Remember, your financial goals are personal to you. There's no right or wrong answer. The key is to have a clear vision of what you want to achieve and then create an investment plan to help you get there. Now, let's talk about the different types of investments, the building blocks of your portfolio. Understanding these building blocks is crucial for making informed decisions and achieving your financial goals. Three common asset classes are stocks, bonds, and funds, mutual funds, and ETFs. Each of these asset classes has unique characteristics and serves different purposes in your investment strategy. Stocks represent ownership in a company. When you buy a stock, you're buying a small piece of that company. This ownership entitles you to a share of the company's profits, which can be paid out as dividends. When you buy a stock, you're buying a small piece of that company. This means you have a stake in the company's future success or failure. The value of your stock can rise or fall based on the company's performance and market conditions. Stocks offer the potential for high returns, but they also come with higher risk. The stock market can be volatile, and prices can fluctuate widely in a short period. This volatility can lead to significant gains, but also substantial losses. Bonds are like loans you give to a company or government. When you buy a bond, you're essentially lending money to the issuer in exchange for regular interest payments. When you buy a bond, you're lending money in exchange for regular interest payments and the return of your principal at maturity. Bonds are generally considered safer investments compared to stocks because they provide a fixed income stream. Bonds are generally considered less risky than stocks. They can provide stability to your portfolio, especially during times of market uncertainty. However, the returns on bonds are typically lower than those of stocks. Mutual funds and ETFs pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. This pooling of resources allows individual investors to access a broader range of investments than they could on their own. They offer instant diversification and are managed by professionals, making them a popular choice for beginners. Professional management means that experienced fund managers make investment decisions on behalf of the investors, aiming to achieve the best possible returns. Understanding the characteristics of these different asset classes is essential for building a well-rounded portfolio. Diversification helps spread risk and can lead to more stable returns over time. Each asset class plays a different role and carries a different level of risk and potential return. By combining stocks, bonds, and funds in your portfolio, you can balance risk and reward to align with your financial goals and risk tolerance. This strategic mix is key to long-term investment success. Section 4. Risk and diversification. Protecting your investment. Risk and diversification are two crucial concepts in investing. Risk refers to the possibility of losing some or all of your investment. Different investments come with different levels of risk. Diversification is like not putting all your eggs in one basket. It means spreading your investments across different asset classes, industries, and geographies. This helps reduce the impact of any single investment performing poorly. Imagine you invest all your money in a single company's stock, and that company faces unexpected challenges. Your entire investment would be at risk. But if you had diversified your portfolio across different stocks, bonds, and other assets, the impact of one poor performer would be minimized. Diversification is a key strategy for managing risk and protecting your investments in the long run. It's about finding the right balance between risk and potential return based on your investment goals and risk tolerance. Section 5. Creating your portfolio, a step-by-step guide. This section will walk you through the essential steps to build a robust investment portfolio that aligns with your financial goals and risk tolerance. Now that you understand the basics, let's create a simple investment portfolio. This process involves several key steps, each crucial to ensuring your investments are well-balanced and positioned for growth. Step 1. Determine your asset allocation. This is the foundation of your portfolio and involves deciding how to distribute your investments across various asset classes. This refers to the percentage of your portfolio you'll allocate to different asset classes, like stocks and bonds. Asset allocation is crucial because it helps manage risk and can significantly impact your portfolio's performance. A common starting point is a 70-30 portfolio. 70% in stocks for growth and 30% in bonds for stability. This mix provides a balance between potential returns and risk. Step 2. Choose your investments. This step involves selecting specific securities within each asset class to build your portfolio. Select specific investments within each asset class. This could include individual stocks, bonds, mutual funds, or exchange-traded funds, ETFs. You can start with broad market index funds or ETFs, which track a specific market index like the S&P 500, providing instant diversification. These funds are a great way to gain exposure to a wide range of assets without having to pick individual stocks. Step 3. Open an investment account. This is where you'll hold your investments and manage your portfolio. Choose a reputable brokerage firm or online platform that aligns with your needs and offers the investment options you're looking for. Consider factors like fees, ease of use, and customer service when making your choice. Step 4. Make your first investment. This is an exciting step where you start putting your money to work. Start small and gradually increase your investment amount over time. This approach allows you to get comfortable with the process and adjust your strategy as needed. You can set up automatic investments to make the process seamless. This way, a set amount of money is invested at regular intervals, helping you stay disciplined and take advantage of dollar-cost averaging. Remember, creating a portfolio is not a one-time event. It's a dynamic process that evolves with your financial goals and market conditions. It's an ongoing process that requires monitoring, adjustments, and rebalancing over time. Regularly review your portfolio to ensure it remains aligned with your objectives and make changes as necessary to stay on track.